Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending November 23rd, 2018. A holiday week comes to a close. What a turkey gobbler of a week this one was. Well, before I jump into the charts here, October was one of the worst months since 2008. For the month, that's when everything started. I think we closed down about 7.2%. For the S&P. The Dow was down over 5.4%. Nasdaq was down about 9%. Now, this past week, Turkey Week, a gobbler, as I said, it was one of the worst weeks for the indexes in quite some time. The S&P closed down 3.8%. It was down, by the way, 1.6% the prior week. The Dow was down this week 4.4% in this holiday shortened week, very low volume. It was down 2.2% the prior week. And then Nasdaq, if everything wasn't as bad as it seemed, Nasdaq kind of finished it off. We were down 4.3% in Nasdaq, and the week prior it was down 2.2%. So I guess you guys are seeing a trend here. The VIX, the VIX finished the week at 21.52. So it was up from the prior week of 18.14 by double digits. Excuse me. So we've seen volatility come up. We've seen price action continue to weaken. And for this week, just looking across all the major sectors in the S&P, not one sector finished up. The best performing sector was the utilities. It was down only 1.31%. The worst was technology. It was down another 5.48%. Now, another thing that I'm watching here is valuations of the market. The current PE ratio, the 12-month forward PE ratio for the market is at 15.98. This time last year, almost to the day, the PE ratio was 21.81. So we've seen valuations drop by 26.71% in the past 12 months. So, by the way, this valuation at roughly 15.9 is the lowest valuation we've seen since the market drop in early 2016 when the PE ratio was down around 15. So we are starting to see, excuse me, I'm fighting a tough cold over this holiday weekend, but we are starting to see valuations get to the point where we're going to possibly get some money coming back into the markets. I will throw out another stat for you stat crazy hounds that are out there. This fourth quarter, we're about halfway through the fourth quarter. We got maybe about 5-6 weeks, so maybe about 60% of the way through the fourth quarter. And so far, we're off to the worst start. Let me rephrase that. We're off to the third worst start in Q4 since 1946. Okay, that is huge. Now, we had a similar kind of start in 2007 and 2008 with that big recession that we had. But this is one of the worst starts that we've had going back to 1946. And I will say, though, for the stat hounds, on average, when we've had this bad of a start going into the seasonally strongest time of the year, 81% of the time we've seen the indexes bounce up 5%. Okay. So I just thought I'd throw that out there for anybody who's tracking this. Now, this week was a holiday shortened week. The market cap of the S&P around 24 trillion. On average, every day, about 50 billion trades. We weren't even at 20% of that this week. So about, if you look at it, about 0.2%, maybe 20 basis points of the entire market cap is really actively being traded each day, So that just kind of gives you an idea of just the small sliver of what's actually moving out there. The other thing that we've got coming up this week, and then I'm going to jump into these charts, is we got two key events. We got Fed Chairman, our own Power Ranger Powell. He's speaking at the Economic Club this week, I think on Wednesday, let me just check that and see. Yeah, he's speaking on Wednesday in New York City. Everybody wants to know what he's going to say, okay? Two more rate hikes through the end of 2019 is what the markets are forecasting. That would be one this December 19th, another 25 basis point rate hike, and then one more next year. However, the Feds have penciled in, since their last meeting, 4 rate hikes, one this December and 3 next year. So obviously, everybody wants to know what this guy's going to say. He kind of set the ball rolling in early October when he said we're not even near a neutral rate. We may need to be more aggressive, and that really started move the markets lower right out of the gate going into Q4. Now I think he wish he could take those words back. He's going to get a chance this Wednesday. The other major event coming up is going to be Trump and Xi. It's kind of like Godzilla meets Megalodon. I don't know which is which, but they're going to be meeting. I don't know if the meeting is Friday or Saturday. And it seems like right now it's on track to be Saturday, which means that any positive news is going to hit for Sunday night futures market open. We're not going to be able to trade it during the day. But the markets are anticipating some bit of news out of the White House that at least Trump will say something to the effect of, they're not going to solve the issues, but just enough so that he can delay the additional 15% tariff on the 10% that's already there of 250 billion in goods coming in from China. So that is kind of what these two major events are that are going to be happening next week. Now we've got the other thing that occurred this week is that we just saw a major capitulation in the oil markets. In the oil complex, we saw natural gas move up dramatically and then give it all back up and then move back up again. Very ugly market. Oil markets are probably perhaps even more ugly with the huge move lower, over 30% in about a month, 5 weeks. This past week, we saw one of the biggest drops in years in oil, down 11%. And now the markets are trying to ascertain how much of this is a supply issue with an oversupply, or how much of it is an economic growth story issue. The oil markets and the energy markets, just like precious metals, sometimes is traded more on perception and emotion than fundamentals. Fundamentals will eventually win out, but near term, up to 30, 40 days out, you've got a lot of perception and a lot of emotion. And we've seen that probably overshoot to the downside. Now, we're going to see OPEC meet on December the 6th. Speculation is they're going to cut production, try and get supply back a little bit more in alignment here. But that remains to be seen. If you guys recall from my weekly updates here in the markets in our weekly roundup, I've been calling for oil to come down. When it was at 75, my call was for oil to come down to the low 60s. I know some of our members took the trade, made very good money, 7 figures on the trade, did very well in the oil futures market. It was at 75, and if you guys will remember, Goldman and Morgan and Citi were saying oil was going to go to $100 a barrel. I, on the other hand, was out there saying oil's going lower. Okay, there's no way it's going to go up over 80. No way. And sure enough, it fell. So that's kind of what we've got going on in the energy complex right now. So let's go take a look at the charts. What you've got on the screen right here is a daily chart of the S&P 500 E-mini futures. I've got a lot of things going on the screen here. Let me just kind of point out what they all are. Obviously, you can see the 2018 open price, 2018 high, 2018 low. You can see this channel that we were in. We tried to break out of it, and now we've kind of taken the same directional path of this channel. It only shifted forward just a little bit, okay? So we've had this directional bias like this, and then we tried to form a channel up in this like range right here. But I was telling our members, be ready for a rollover because this thing is just going to roll right back over again. And sure enough, it broke the channel here, and now we've got another channel that's going like that. That's got pretty much the same vector, perhaps a little bit steeper than this vector right here. Okay, we're going to come down and test the lows that we made in October of 2603. I suspect we may go a little bit below them. I don't know if we're going to hit the 2018 lows, although a lot of people on TV and analysts are saying we're going to test those lows. Hard to tell right now, but I do believe because we're coming in this seasonal strong period, I think Black Friday is going to be an amazing day. It's going to give a further lift to retailers. I think there could be some buyers willing to step in and punch the prices a little bit higher. But remember, momentum is really to the downside. The other thing that is catching my eye here is, now this is an EMA, 50 EMA right there, and then the yellow right there is the 200 EMA. Okay, we are pretty darn close to crossing. Now, we've had crosses before in the 50 and the 200, and the markets go batshit crazy when that happens. You've got algos that seem to be more present now than before, that start these, cells that the minute it happens. Okay, now, generally, this area of the cross becomes a solid resistance point. By time you have a cross, more than 50% of the time you see the markets moving up towards the cross. Okay, that would give us that little bit of a move higher and give people a chance to set up for another roll back over again. We have shifted our bias. My bias shifted back in the second week of October from a buy the dip to a sell the rally kind of mode. And that's where we've been since. And we're just following the price action here. So we're not going to get too far out of whack with what the prices are doing. The other thing I want to show you on the chart here, you can see I've got these bars on here, this red bar, this kind of, I guess, blue bar, and then a green bar. These show pivot highs and pivot lows and value areas within a very short time frame, generally about a week. And you can see we just keep blowing through the pivot lows, which is the green, and now we're coming down in this area down here. So the next pivot low is sitting down around 26.22, which is kind of where we almost ended up this Friday. The other thing that you see on my screen is these colored bars moving left to right off the screen here. Now, the nice thing about this, I'm using a market profile or a market map, and it kind of paints where all the volume tends to congregate around prices. These yellow lines here, there's one there, there's one there, and there's one here. I don't know if you can see it, but the longest one right here is where the most volume took place over price, because there's only two things that move markets, volume and price, at the end of the day. And you can see right in these areas here is where we've had, right down in this area here, I've circled the price levels where we had the most volume take place. Now, we've overshot that as normal. Momentum has carried us down to this level down here. Now, notice I've got it stopped right here. This is a 90-day market map. So what it does is it paints the picture of where all of the volume has taken place, where the yellow represents the most volume, and then these little green bars there that you can barely see represent the least volume. These least volume areas here, if I were to extend it off, tends to be support or resistance zones depending on the location of price. Okay, so that's a little bit about how that works. Now, what I've done is I've added 3 market maps to my chart. So if we just go back again, here's another market map that goes back another 90 days. It starts right here, and you can see here's another value area. Both of these value areas are sitting around 2730. Okay, and then coming back another 90 days, here's another value area right here. Okay, and this value area is around 2660. So looking at these value areas, that's kind of about where we're sitting right now. This gives me a good idea of where price action, where bulls and bears tend to be in an equilibrium, at least for a moment before price action, the bulls went out or the bears went out. So it gives me a good idea of what the markets want to do and where they want to go next. Now, if I blow this up a little bit, the other thing I wanted to show you here, especially for our members, they'll know what I'm talking about. This looks like not a poor man, but what we call a bullish divergence. We have bullish divergence, what we call buds, and we have what we call poor man buds. They both work, but the bullish divergence works much better. Now, it hasn't fired yet, but if this does fire, and the way we get these buds to fire is that, let me just get these drawings off my screen here so it can be a little bit clearer for you guys. You can see right in that area there, I'm waiting for a little bit of a bounce right here. Now this would be an official bud if we take out that low right there, perhaps come down in this area here, let the momentum just kind of flush this out a little bit, and then it starts to move higher. That would get the MACD here to start to turn up, and then we would get across something like that. That would then give us two crosses to the downside, and then when you connect the crosses, you got the bullish divergence, and then that gives us this really move back up here to this value area, sitting around 27.22. Okay, and you can see that small little shaded zone there as well. So that would not surprise me at all as we come out of the holidays and we come into the first week in December. Okay, we've got one more week of November. So over the next 2 weeks, I'm expecting a bounce. That's what the statistics would show. The charts, we don't play a bounce until we see a bounce. All right, we're not trying to guess if we're going to get a bounce on Monday or Tuesday, but if the chart action and the price and the volume confirm that, then we will take the trade. Obviously, the next major area of resistance is really going to be this area right up here around 28.28. This or 28. 25 area right here. This is going to be a huge resistance zone. Okay, so we've got some major pivots that we have to overcome. Just going back here since the markets really kind of fell in October, we've got a big pivot there, a pivot here, a pivot here, a pivot here, and then we're waiting to form a pivot here. Okay, we're still in this down mode. I can connect the tight channel like that and say until that breaks, we honor the channel. Okay, so the question is, will we make a new pivot low here? Okay, or will we stop at that pivot point? Because the markets move based on pivot points, price over volume, and volume over price, both of them intertwine to create higher pivot highs or lower pivot highs, lower pivot lows, and vice versa. So we're watching this very closely just to see where we're going to go. Okay, you can see there's the 2018 open price. We're already in the red for the year. So if we can get that bullish divergence, that would suggest we will move back into the green in the first week of December or perhaps next week. Again, we're counting on Trump and Power Ranger Powell, as I said earlier, to goose the markets. If they don't, we're going to continue to see some of this sell-off here. Now, keep in mind that the market, the economics of the U.S. are still fundamentally very sound. This is nothing more than a repricing of the price-earnings ratio. And as I've said many times on this weekly roundup, there's only two things that move prices over a period of time. Okay, day to day, flip a coin. But over a longer period of time, there's only two things: earnings per share and interest rates. And when interest rates start moving higher, like they're doing now, then it's competing for cash. When interest rates were zero, there was no place for money to go to get a yield, any kind of return. So it forced money like digging a trench in a field trying to grow corn on and harvest, and irrigate the field. That's what the Feds have done. They've kind of irrigated the equity markets by zero interest rates. Globally, interest rates, there was at one point over 2 trillion in debt that was negative interest rates, everything. And it forced money into asset classes that probably went higher than they should. So what we're getting is a repricing of that, right? It's that simple. People are trying to make this out to be a lot more complicated. Now, you've got to follow the price action, and I know people like to guess which way prices are going to move in the markets, and you can't do that, all right? But what you can do is follow the key momentum indicators and price over volume, and it'll help you out tremendously. And you'll never get caught in a down market just being long and then hoping and praying, okay? So that's kind of where we're sitting here. And if we look at Nasdaq, which has really come under the gun, you can see the Nasdaq is still above, the Nasdaq futures anyway, is still above the open price for the year, and the low and the open this should be the that should say the open. So let me just get that changed there on my tool here and just have it say open. So, and then you've got the 2018 low right there. So you can see where price action is sitting on Nasdaq. And if we look at volume over price and look at the market maps going back, you know, to begin each one of these market maps again covers one full quarter. You can see where we're sitting right now. We've got a lot of support sitting around 6,300. We've got a pretty good little area of support from 66.74 up to about 68.27. So I think we're going to find some support here. And like the S&P 500 E-mini futures, we're trying to set up for a bullish divergence here. Okay, we will see if we can get that. But just like the S&P 500 E-mini futures, we've got the 50 looking to cross the 200 EMA. So that would give us really, I would shift my bias to full tilt boogie bearish. Right now I'm neutral to bearish, but let's see how this thing shakes itself out. I may shift over to bearish because we haven't had a cross in the 50 and the 200 EMA. And then let's just go back. And this is Nasdaq, because Nasdaq has kind of led the ways. Okay. And if I just bring it back out here in time, you can just see, and let me just show you just how far back it goes. The last time we had a cross in the 50 and the 200, and it crossed multiple times, was back in 2016. Okay. Remember, I said the PE ratios now are coming in right at where we were around 2016. So we've got PE ratios the same down here, but the price action is a lot higher because of stronger earnings and a few other things. But that just shows you just how far down we've come. And you can see the MACD over on the far right, just how low it's been with the selling. We've got a capitulation in the technology market. So that's a little bit about what we're seeing. Now, if we look at volatility, just a different view for you guys. If we just look at the VIX to kick things off, you can see it's at 2152. And you can see these zones here, green, yellow, rose, red, and then black way up here. That would be the black swan up in that area here. And you could see we're in this yellow to rose area, and we've been there since the beginning of October, and we've stayed up here for an extended period of time. You normally don't get this extension with the volatility. We haven't been over 20 for a period of time. I mean, look at this. We've been up here over 20 many times. If we come back to the beginning of the year, you can see here we actually went into just briefly poked our head into a black swan event here. And in fact, it was a black swan event, if you remember. Now, I see the TV talking heads trying to say, well, volatility hadn't gone up enough because back in February, it was up here, in the 30s and 40s. Well, there's a big difference between the market regime, the volatility complex back here in January and February than what we've got now. If you guys remember what led up to this, well, if we swing back to 2017, look at this. We were in the green the entire time in 2017. And what was the trade of the day, the trade du jour? Look at this. I'm just going back here. 2017. We pretty much stayed in the green. I don't think we had more than 5 days where the S&P moved more than 1.5% the entire year. Everybody and their uncle was short volatility. They were going out and shorting the back month vol futures, and then it was a very good trade. They were making 30, 40, 50% in that year just doing that. And look at what happened, though, when everybody loaded up on that trade. Now, everybody was short. They're on one side of the bucket. Being on that one side of the bucket, the minute we had that downdraft in February, that forced everybody to the exit door at the same time. And because liquidity wasn't that strong, there were 300,000 contracts trying to be sold after markets closed on one day, and that caused the spike in the VIX. In fact, it was so severe it caused the liquidation of XIV. So strange things do happen in the market. You've got to understand that, and this was something that had not happened before. Have an ETF liquidate because everybody was on one side of the ship. So that just shows you that things can always happen that are uncalled for. I don't think after this big move back here like this, a lot of money got out of that short vol trade. Now there's still firms doing short vol going out in time, but they're hedging it with out of the money long VIX calls as well, which is an interesting trade, by the way. But it has reduced these really huge spikes. Okay, so can we get a spike into the red zone, which is up over 30, 31? Yeah, sure, we can. But I just don't think it's going to be as severe as we saw in February, at least not from what I'm seeing right now. So that's a little bit about the VIX. Now, if we look at the front month vol term structure, you can see right here, anything in the red, we're in a backwardation term structure, which means the VIX is higher than the front month vol futures, which now is the December contract, the Z18 contract. And we're in the red. Anytime we move into the green, that means the DECE contract is higher than the VIX. And that's the way it should be, normal contango term structure. So, for those of you that have Thinkorswim or eSignal, you probably want to set up a chart like this so you can just look at it real quick and say, are the markets normal or abnormal? When we go into backwardation, that happens maybe about 20% of the time. You can see we've been in backwardation for quite some time. Since October, the markets have been in a backwardation market here. Now, if we look at the back month term structure, this would be December and January. This term structure here is what drives VXX, okay? For our members, I've got some good videos on how this all works. Most people do not understand how VXX works. Most people do not understand how to trade VIX calls either. But if you look at this, we're just barely hugging the contango. Now, we just changed over this past Wednesday to the DECE volatility futures being the front month. And now January is the back month. So we're going to look at these and follow these and see how this thing goes. But this right now adds a little bit more of a negative roll yield to the VXX trade, which is a positive thing. All right, so let's look at volatility, guys. If we come over here and we look at treasuries for a minute, you can see the bond market is attempting to regain some footing. Now, I was calling for the bond market to move higher. However, in addition to that, I do believe we've got a lot of resistance up at this level up here, not too much higher. And then really right now it's kind of in the hands of Power Ranger Powell. If they ease off a little bit, we'll see bonds kind of drift. It's not going to go too much higher, but I don't think it's going to go too much lower at this point in time. Okay, that's the bond market. And then of course, if we come down and look at currencies and we look at the U.S. dollar, we're near the 2018 highs, and you could see here that we're getting some divergence here. So I could see a little bit of a settling in on the U.S. dollar. I don't see it going much lower than 95, which is kind of, you can see a lot of volume over price here. So right now we're sitting in the next support area to the downside is 96.26 for the dollar index. I don't see it going much lower than the 95 zone, okay? And then by the same token, if we look at the euro currency, you can see here that we're off of the 2018 lows. But I just, for me in the euro, I've never been a big believer in the euro anyway. I just never have. So that's a little bit about where we're sitting there on the euro. Now, the British pound, I want this sucker to go lower because I'm ready to go long the British pound. You can see here, it cannot get elevation. It cannot get escape velocity. I think if they solve this Brexit and they do get away, you're going to see the pound moving right back up to the 140 area. It'll be a good run. Right now, the pound is nothing more than a headline news event, so it's very choppy. But until we can get a little bit more clarity around the Brexit, then I want the pound to go lower, and I'm willing to play it to the long side. Oil, if we look at oil, my, oh my, oh my, look at this chart, folks. I mean, this is ugly, ugly. This was 2018 highs around 76, $77 a barrel. And then look at this thing. It just capitulation all the way down. There is nothing there. Any rise in oil is probably going to be sold off. Everybody was long oil up in this area here. I was saying oil was going to come into the low 60s. Kind of overshot my level. And you can see here these volume over price. We've blown through all of them. So what this is going to be, this 38 fib move is going to be a resistance point on the way back up, 57.53. Okay. We're at 50, or we closed the Friday at 50.39. I think we're going to see the high 40s. If I come in and put it on a weekly chart, just to show you a little bit better view of the volume over price, you can see this, we broke this trend line. And then there's a huge support area around 48 down to 46. So 48 to 46 is my support area for oil. Then I would be willing to dip my toe in the water on a little bit of a move higher. But I don't see this thing getting too far north of this price. You can see the shaded zone here with this yellow bar, which is volume over price, going all the way back to February of 2017. So that to me is where a lot of buyers are probably going to be willing to step in. Okay. I think the global growth story has been overdone in the oil complex. So that's a little bit about where we're sitting now. And if we look at nat gas, I mean, nat gas was ugly, ugly, ugly. Look at this chart for nat gas. This is a weekly chart here. I mean, that is the spaceship. Let's put it on a daily just to get a little bit of a better view. You can see here on daily, we're just blowing through everything here. Got caught in an undersupply, low inventories. Armour's Almanac called for a very cold winter, and away we went. This is one of the reasons why I don't like trading nat gas, because sometimes when you get out of whack like this, the markets go batshit crazy. I will say, though, this is setting up for a possibly good short. If we come into a weekly chart, anytime you get an extension like that, playing it to the downside now appeals to me. You can see back over here, when you have these big spikes, nat gas wants to come back down to the base of the spike, which would put us back down around the 363 area. It's at 43 right now. Okay. But this spike may not be over with. As you can see here, we spiked and then we moved up again dramatically before it kind of settled in. So what you probably want to do here is any kind of trade, I would not do a credit spread or a credit trade, even though vol is very high, because you'll lose. You have to do it as a spread. You can't do a naked short call up in this area. That'd be suicide. And I almost like, even though volatility is very high, picking up some puts. Now, I wouldn't do it in nat gas, although you can. Probably an interesting play would be UNG. The volatility percentile in UNG is very high. You can see this volume over price here on weekly, and we're sitting right here. All right. And this thing just wants to roll back over. So if we put it on a daily, I think the odds of this coming back in are pretty good, right? And if you buy a put here, granted the put's going to cost you a little bit of money, but you can see, let me see if I can get this thing to paint on here like this. Let me just move it around. Let's try 5 minute and then let's bounce back to a daily. Okay, here we go. So you can see right in this area here, we've blown through all these pivot levels. But right now, UNG is sitting around 36, 37. I wouldn't be surprised, folks, in another week to see it sitting around 30, 31, come down in this level here, and then eventually settle back in around 26. So another 10-point, another big move to the downside. Now, I will tell you, if you go long puts here, long Vega, long Gamma, that would be the way I would trade it. You're going to be paying up for those puts because there's huge volatility in this. And the market makers, they already know it, so they've jacked up the price of the puts. But if it does move down here, it'd be a nice little trade. You can make some nice money in the move. But that's what I'm looking at, and something we'll take a look at in our markets here. Now, the other thing I wanted to show you is the spread. I should have done it when I was talking about WTI, but here is the spread between Brent and WTI. Okay. Now, with all that wicked move in oil, this here, we shorted the spread, Brent and WTI, to the downside. You can do it in Thinkorswim. Now we're coming up here and we're breaking down again. So, and this breakdown here shows that Brent is coming down, WTI is coming down Brent is coming down at a faster rate than WTI. I think if WTI starts moving up and Brent stabilizes, you're going to see this come back down again. So this is $1,000 a point. To me, this is a signal to play the spread, to short the spread. And what you would do is you would sell Brent and you would buy WTI. Okay, you don't need, and just one contract each, and then you got the play. It's $1,000 a point. If we look at metal, precious metal, look at gold. It's trying to break out here. This is a daily chart. All right, let's blow it up. I'm not ready to go long gold yet. We're sitting almost right at this value area, as you can see here. And if I widen it out just a little bit and just kind of go out, the next value area for gold is way up here around 13.15. You can see that huge fall down here. There's a lot of dry powder in this area here. I think gold has first got to get over the 200 EMA. All right. And it tried to break out here, but there's just not enough juice. Okay. So this is where we're sitting with gold. I am not long gold at this point in time, although selling puts underneath gold to me makes sense because it looks like we're forming this long, consolidated, rounded bottom here. Okay. And that would indicate to me gold is in a consolidation mode. If we put it on a weekly chart, just to step it out a bit, you can see here as I move it out in time, it's a little bit volatile, but you can see here this long consolidation for gold. Okay, now this again, it goes back all the way back to 2013, but you can see this move like this as I just kind of do it like this, right? And it could eventually form a cup and handle as it moves up in time over the next couple of years and down, and then away it goes. But this is kind of how I see this playing itself out. Now, this is the big resistance point right in this area here. It's a little bit over 1,300. But if we take out the 200 EMA here, I would play it up to the top of this little, what looks like a spoon, I guess. I would play that. Right now, I'm not. All right. I think there will be a good time and place to play gold, but at this point in time, as you can see, I don't see this playing out. There is a lot of volume over price at 1280. So there could be a little bit of a resistance at that point. So a move up there and then another consolidation point before we take out the mythical 1300 level. Okay. So that's how I would kind of see gold. And then we've got silver and copper and all those others that are out there. We got agriculture, meats, softs. We got some ratio charts that we're following. And then we got a lot of stocks that are on our watch list that we're playing, and some active trades that we're running, and a few others here. So if you're not a member of our group, I highly encourage you to come in. Over the next couple of years, there's going to be some really interesting things happening in the market. And you definitely want to be a part of our group as we take advantage of them, especially in the commodity arena, because sometimes the commodities, while the markets are crashing, commodities are going up or vice versa. And playing these commodities, especially if we roll into a bear market, and we will roll into one, it's just a matter of when. I think there's going to be some great opportunities all around. All right, everybody, have a good remainder of your long holiday weekend. I just wanted to get this out. Members, we're off tomorrow night, and we will pick it up with our pre-market again this next Wednesday. Otherwise, I'll see you in our live chat room Monday morning. Take care, folks. Have a really great holiday weekend and continue to eat that turkey and watch football. Gobble, gobble.